Yeah, I mean, we have these event risks out there, clearly, and, we're getting towards that November 3rd election. I think that will be something for markets to have to deal with and get past. You could argue maybe having had the European Recovery Fund passed, that for the first time in a long time, if you look between now and the end of the year at least, there's maybe a little bit more political risk in the US than there is in continental Europe, which is, has been a rare event. So, I think there will be, of course, focus on that US election. I think there'll be focus on government responses to these, higher COVID-19 cases. How does that impact the economy? And as we saw with the PMIs last week, the flash PMIs in Eurozone falling back down to basically break even at 50, I think the macro data will be key to watch as we go into the fourth quarter. And of course, how corporates are recovering. Are corporates' earnings coming out of this trough? Are they recovering? Are they starting to print decent numbers, which would bode well for 2021?
Nick, just kind of a technical question in some ways. Where would the money come from for equity market rallies? Will it come from central bank largesse? Will it come from the bond market? Will it come from buybacks? I'm just wondering, is the money sitting on the sidelines in cash? What has to be the other side of the trade if we do see an equity revaluation?
Well, I think certainly if you look at equities relative to bonds, and not just government bonds, but corporate credit, investment grade, even high yield, I mean, the yields you're getting in Europe, European dividend yields are over 3%. They're pretty much bang in line with long run averages. And of course, we've got core government bond yields negative pretty much everywhere in Europe, minus 40, minus 50 bips or so for bunds and so on. And I think you could easily see some reallocation out of fixed income assets. You have central bank balance sheets, as you referred to, which have absolutely exploded in terms of the size of the assets on those balance sheets. You have households that have been increasing their savings, which is a sort of precautionary saving ahead of the slowdown and the expected rise in unemployment. So there's some retail money, less obviously important to Europe than it is in the US, but that's on the sidelines. And then for Europe itself, I think it's mainly foreign investors, right? So, we have seen since about May or June a little bit of money come through from US investors coming into Europe. It's not been trillions of dollars coming across the Atlantic, but we've started to see US investors nibble at exposure to Europe. And that, I think, would be the main driver for Europe to see foreign investors coming back.